Hi guys, this is Sean from 𝐶entric Wealth Advisory. It's been a while since I've made a video, but I thought I would make this video with regards to the tax-free savings accounts. And the reason for this is because the financial year end is approaching on the 28th of February, and we try and encourage investors who have not utilized their tax-free savings account annual limit of 36,000 that they do that so that they have one financial year contributing towards the 500,000 limit. But that being said, there's a few things that I have noticed when speaking to people and also reviewing portfolios of clients that are looking to get an opinion on their portfolio, is that firstly, there's a number of people that have a tax-free savings account with multiple platforms. You can open up a tax-free savings account with your bank. You can open it up with your life company. You can open up with your medical scheme, Discovery, for example, have through Discovery Invest. And of course, obviously, you can go through to a platform like Allan Gray and open up a tax-free savings account if you've got retirement annuities with them or whatever the case may be. And a few things I just want to make you aware with regards to tax-free savings accounts, because um, there is no real way for people to track the contributions they're making, either on a monthly debit order or if they are making ad hoc payments into their tax-free savings account throughout the financial tax year. And what I've noticed is that some people are essentially making contributions into the tax-free savings accounts and not realizing that they have potentially over contributed for the financial year, in other words, the 36,000 limit. And they might have had the misconception that you can make contributions of 36,000 per tax-free savings account and not across the tax-free savings accounts. And as a result of that, anything above the 36,000 Rand for the year, you will have a 40% penalty, which becomes a tax liability to SARS, which is quite a hefty amount depending on what the over contribution was. So, in other words, if you've got, let's say, 2 or 3 tax-free savings accounts that you've opened, you've got a debit order running on one with the maximum debit order ideally is 3,000 a month because to get to 36. And let's say you've got one TFSA running with a debit order, and you've now got tax-free savings accounts with other platforms, and you go and make ad hoc contributions of say 20,000 and maybe 10,000. As soon as you go over the 36,000, and it's your responsibility to keep track of all the contributions you're making throughout the financial year, because the institutions will only have the record of what you have contributed on their platform. For example, Allan Gray will be able to tell you what you've contributed on their platform. They won't know what you've contributed, let's say, on 𝐂𝐧𝐬equities, or if you've got a tax-free savings account with your bank. They're not going to know what you've contributed throughout the year. Only SARS will know when you do your filing for tax returns. You will have an IT3 certificate that will be issued per institution where you've made your contributions. So SARS will know exactly how much you've contributed for the financial year and who you've contributed with. And they will know if you've over contributed above the 36,000, that's where they apply that 40% penalty, and that becomes a tax liability in that financial year. So that's the first thing I just want to make people aware who are not familiar with that rule. And secondly, the most important one, I think, with regards to the tax-free savings account, is that SARS only allows you to contribute a maximum of 500,000 Rand in your lifetime. So what that means is if you're putting money into your tax-free savings account, SARS keeps a track of all your lifetime contributions that you've made. So if you're putting money into your tax-free savings account and you're making regular withdrawals, let's say once or twice a year for whatever reason, SARS will say you have now utilized a portion of that. You cannot top up your tax-free savings account to replenish what you have essentially withdrawn. So if you've made 100,000 rands worth of contributions towards your tax-free savings account up until this point, and you've withdrawn 50,000 rand, which is tax-free, SARS will still record 100,000 rand that has been contributed. We're only allowed 400,000 rand left. So if you go and put in 50,000 rand back into your tax-free savings account over, say, 2 years, SARS will not say, well, you've now topped up what you've taken out. They'll take that 50,000 and they'll deduct it off the 400,000 that you've got left. You'll have 350,000 left once you've done that additional contributions. So that's very important because the tax-free savings account really is an investment that you should keep for the long term. And the reason why I'm saying this is because if you take 500,000 and you divide it by the annual limit, which is currently 36, it might potentially increase. SARS might decide to increase that to, say, 40,000. It depends on when the changes come in for the financial year. But up at this point in time, it's 36,000 per year. So that's what the limit is. But if you take 500,000 divided by 36, you get an idea. If you start in your tax-free savings account this financial year, then you will know how many years it'll take for you to utilize that full 500,000. And ideally, you want to keep that tax-free savings account running well past your 500,000 rand annual lifetime contribution, because that's going to continue to grow interest compounded without any tax that is liable, which means that all interest accrued, there's no tax liability. If you make switches in that tax-free savings account with regards to funds or asset class allocations, there is no capital gains tax applicable. So it really is a powerful investment vehicle that you can let run for 20, 30 years up until the time you reach retirement. And those proceeds will also be tax-free, which means that it really supplements your retirement funds, which would be, your pension fund, if it's a retirement annuity, and of course, any other investments you might be drawing an income from. That tax-free savings account can be used to potentially settle debt. It can be used to supplement income without having to worry about tax. There's a lot of things that it can be used for. But if you're continually making withdrawals from your tax-free savings account, and you essentially burn through that 500,000 lifetime limit, you will not be able to open up a new tax-free savings account in the future and try and put another 500,000. SARS will not allow you to do that. You will just be paying 40% penalty every single year, which means you just have this massive tax liability that you need to be paying, which is not worth it. So those are two things that I think are really, really important. Is because a lot of people see the tax-free savings account, the savings portion of that, is almost like a savings account with a bank. If you open up a tax-free savings account with your bank, do not be fooled in thinking that you put money in, you can take money out. It's almost like a savings account and you get an interest on it and you can utilize it for making contributions and withdrawals. SARS is keeping track of all those contributions and all those withdrawals. And if you over contribute, there's a penalty. If you are taking withdrawals, your 500,000 is depleting as you are doing that. And you cannot, as I say, top up once you've made those withdrawals. So this is really quite important for people to understand because unfortunately, with the two-part system that was introduced on the 1st of September 2024, people have been accessing the savings pot of their retirement funds, and that is subject to tax, but people are doing that. And now, in addition to this, they're looking at their tax-free savings and saying, well, I'm paying the marginal tax on my savings pot for withdrawals that I'm making in the financial year. Maybe I should access my tax-free savings because I don't pay that tax at my marginal tax rate. And unfortunately, without that knowledge, you are throwing away a really, really good investment that can be beneficial for you in years to come if you leave it as long as possible. And secondly, with your savings pot, every time you access money from your savings pot, you're potentially eroding future retirement capital that you could utilize. And secondly, you're paying SARS up to 45% tax on any withdrawals. So really, you need to structure your portfolio that you've got your tax-free savings account running completely separate from your savings that you would utilize to your savings pot, and also leave that as long as you possibly can to not pay tax. And then you have your tax vehicle, your savings vehicles, which could be through a bank, could be a fixed deposit, could be a savings account that earns a bit of interest. You can put your money away into a unit trust that's, you know, there for a rainy day. That's where you can utilize a financial planner to give you guidance on that. But these are the two things I just want you to make you aware of with regards to the annual contribution and the lifetime contributions, because a lot of people are not understanding this, and they are essentially throwing away a tax-free savings account, which will be a once-off thing in their life they can that they can utilize to seriously build a large amount of additional wealth. So those are two things that I hope people will understand. If you're uncertain, speak to your bank, get the terms and conditions, or speak to whichever supplier you have. They will say exactly the same thing. Or speak to a financial planner that you are maybe working with and just get, their input from it, so that you make sure that you are utilizing the investments that you have to the full extent. Anyway, this is just my 2 cents. I hope you find this valuable for those who are not aware, and look forward to making future videos soon. Bye for now.